It's been a huge earnings season so far, and today I'm running through 3 ASX small caps that not only reported solid results, but are showing real share price momentum right now. Before we get into it though, just a quick reminder to check the description below for AFSL details, and of course, nothing here is intended as financial advice. Any advice under the law is general advice only, as we've not considered your personal circumstances. First up, we've got an investment and wealth management business that's been around for decades, but just delivered one of its strongest set of numbers in years. You may not have heard of it, but it's a $409 million market cap company called Fiducian Group, ASX ticker FID. Fiducian is a financial services business with 3 main parts. It runs a network of financial advisors, it provides platform administration services, and it manages its own suite of investment funds. The model is pretty integrated. Fiducian advisors often place their clients' money into Fiducian funds via the Fiducian platform, which helps keep the whole ecosystem ticking over. Now, onto the results. Fiducian reported revenue of $68.2 million, which was up 13% on last year. Statutory net profit after tax rose 23% to $18.6 million, while underlying NPAT, which strips out non-cash amortisation from acquisitions, was up 19% to just over $21 million. Statutory earnings per share came in at 58.9 cents and underlying EPS at 66.9 cents. Dividends were strong too. The company paid out about 70% of underlying profit, equating to 46.6 cents for the full year, including a final dividend of 27.4 cents. That works out to a trailing yield of roughly 3.7% or 5.3% once you include franking credits. One of Fiducian's long-term selling points has been steady dividend growth, and this result really continues that trend. Free cash flow was also very healthy. After operating cash flow of $22.4 million and taking out capex, loans to advisors and acquisitions, free cash flow landed at almost $20 million. That compares well to reported profit and left Fiducian with $34.9 million in cash at the end of the year, up from $26.6 million the year before. So balance sheet strength looks intact. As for the standout in the report, the funds management segment was clearly the strongest performer in the second half of FY25. That's partly due to favourable market conditions, but it's also evidence of the scalability of that side of the business. The more assets Fiducian allocates, the better fee terms it can negotiate, which supports margins. On the flip side, the platform administration business was weaker. EBITDA actually declined in the second half, despite higher funds under administration. That was quite a surprise, especially since the timing of the prior fee cut should have already flowed through. Management put it down to pricing pressure, and while that may prove temporary, it's an area worth watching, especially since this division used to account for over 40% of profits. Overall though, Fiducian delivered a solid set of numbers across revenue, profit, dividends, cash flow, and balance sheet strength. In terms of the market reaction, the share price jumped around 10% on results day, moving to roughly $12.50 at the time. Since then, it's up further to around $13. That shows that investors liked what they saw, particularly the profit and dividend growth. Finally, a quick note on disclosure. The editor-in-chief of our website, arichlife.com.au, Claude Walker, does own shares in Fiducian. Next up is Aussie Broadband, ticker ABB. This is a telco and internet service provider that's been steadily growing its share of the Australian broadband market. The key differentiator for Aussie is service. They've built a reputation for having an all-Australian call centre and customer support. And that reputation has helped them win customers away from the big incumbents like Telstra and Optus. Now onto the FY25 results. Revenue was up almost 19% to $1.2 billion. That flowed through to a 22% increase in EBIT, which came in at $59.7 million, and a 24.5% increase in NPAT to $32.8 million. Looking at the second half in isolation, revenue grew 8%, EBIT was up 12%, and NPAT was up almost 26% compared to the prior corresponding period. So the earnings momentum is still there, even on shorter-term comparisons. Operationally, Aussie finished the year with 8.4% of on-net NBN market, up more than a full percentage point in 12 months. In a market that only grows in line with the population, taking share is critical, and they've done exactly that. Their reputation clearly matters here. Independent surveys from Roy Morgan have ranked Aussie as Australia's most trusted telco 4 years in a row, and they picked up plenty of other awards for customer satisfaction. As a customer myself, I'd say that reputation is well earned. This trust moat is what sets them apart. It's not impossible for competitors to close, but it slows them down, and Aussie will be able to see them coming. Looking at the different segments now, residential, which is their most important division, kept delivering, with connections up 9% across the year and 4% in the second half alone. Business and enterprise both contributed steadily, while Symbio, which is their voice and software business, chipped in nearly 23% of gross profit. The wholesale segment was a little bit more complicated. Connections surged nearly 70% in the second half, but revenue and profit fell sharply after losing a big contract with Origin. Gross profit went from nearly $20 million in the first half to just $500,000 in the second half. That sounds pretty bad, but it's partly offset by signing 2 new wholesale customers, one of which, Tangerine, also agreed to buy Aussie's low-cost Buddy brand. Buddy lost $10 million in FY25, so handing that off for $8 million should help profitability in FY26 and FY27. I viewed Buddy as an interesting experiment, but not core to the company's overall long-term profit growth, so I don't really see this as a big loss. In fact, it's encouraging to see that management recognised early that Buddy was a distraction and a drag on profits and decided to cut the losses. On the balance sheet side, net debt improved, down from $83.6 million to $77.8 million, leaving leverage at a comfortable 0.56 times EBITDA. For a capital-intensive business like this, that's pretty manageable. The one weak spot in the result was free cash flow. For the full year, free cash flow was negative $17 million, thanks to higher capex, interest costs, and tax payments. But the second half was much stronger, with $12.5 million positive free cash flow compared to a large outflow in the first half. That's something worth monitoring over time, because if investment continues to outpace cash generation, it could mean higher debt or another capital raise. Guidance for FY26 was $157 to $167 million in EBITDA, which is ahead of what I expected. This suggests either margins are improving faster or revenue is coming through faster than forecast. Management did hint that margin pressure across the industry remains an issue, so the more likely explanation is the faster top-line growth. Either way, if they deliver, FY26 should look a lot better than FY25. Management also flagged the potential for acquisitions. They've been running a share buyback, but signalled that they may pause if a good M&A opportunity comes up. As long as the company can continue to grow organically and acquisitions perform as well or better than expected, this should be a positive. The market definitely loved the result. The share price jumped more than 18% on the day to trade at around $5.30. That's a big reaction, and it reflects the strength of both the numbers and the forward guidance. By way of disclosure, I do personally own shares in Aussie Broadband. Finally, let's take a look at Praemium, or ticker PPS. Praemium is an investment platform and managed accounts provider. If you've come across products like NetWealth or Hub24, it sits in that same niche, providing administration, reporting, and investment solutions for advisors and their clients. FY25 results were very strong. Revenue was up almost 25% to $103 million, EBIT rose 44% to $16.9 million, and NPAT climbed 55% to $13.6 million. Looking just at the second half, revenue grew 17%, EBIT was up 56%, and NPAT surged more than 63% versus the same period last year. So earnings momentum clearly improved as the year went on. It's also worth zooming out a bit. Since Anthony Wamsteker became CEO nearly 5 years ago, Praemium has really transformed itself. They integrated PowerWrap, sold off the international operations, and they recently acquired OneView. Over that stretch, revenue has grown nearly 60%, EBIT has gone from a loss to almost $17 million, and NPAT has grown nearly ninefold. That's an impressive turnaround story. Despite that, the share price has lagged. Over the same 5 years, Praemium is only up around 10%. At the current share price of 73.5 cents, and with earnings per share of 2.8 cents, the stock trades on a PE of around 26 times. So the market has been cautious in recognising the financial progress, though one could also argue it was simply overpriced before. Cash flow was another highlight. Free cash flow came in at $9 million for the year, with almost all of it generated in the second half. That's consistent with past years, showing the business tends to be second half weighted. Importantly, cash conversion was also strong, almost 1-to-1 against earnings on a free cash flow basis in the second half. Praemium finished the year with $41 million in cash and no debt. In fact, cash on hand actually exceeded their total liabilities. That's a very clean balance sheet. There wasn't any specific guidance, which is normal given how much platform earnings depend on markets, but management did outline aspirations for ongoing double-digit revenue growth and for EBITDA growth to outpace revenue growth. With the integration of OneView wrapping up and their new Spectrum product largely built, CapEx and integration costs should fall in FY26. That gives them more scope to put money into client acquisition and sales, which management said on the call was their key focus. The market liked the result, and Praemium shares jumped around 12% after the announcement, getting as high as 77.5 cents. The share price has moderated a little since then and sits at around 73.5 cents at the time of recording. And again, for disclosure, I do own shares in Praemium, and I may add to my position, but not for at least 2 days after this video is published. This video is just a taste of the kind of earnings coverage we perform at A Rich Life. Each one of the companies covered today reported strong results and received a positive market reaction. While that doesn't mean that the shares are cheap, these characteristics could bode well for the future. If you'd like more of our ASX analysis, head on over to arichlife.com.au. You'll find a link in the description below. And if you could give this video a like, hit the subscribe button, and leave a comment below, we'd appreciate the support. Thanks. Guests or podcast hosts may have positions in the companies mentioned in this recording. The information contained in this episode is not intended as financial advice and is not a recommendation to buy or sell any financial products. We do not warrant or represent that the information, opinions, or conclusions contained in this episode are accurate, reliable, complete, or current, and you should be aware that any references to past performance are not an indication of future performance.